Hi, I'm Innes McFee, Chief Global Economist at Oxford Economics. In the past week, our research has focused on what the most extreme and persistent inflation overshoot of the inflation targeting era means for monetary policy cycles in the medium term. Now, a key change in this cycle has been the role of inflation expectations. After decades of low and stable inflation, the combination of huge adverse supply shocks and robust demand have woken households and firms up to the possibility of materially higher inflation. Now, we don't think that inflation expectations have become unanchored, but we do think that they've clearly become less well-grounded than policymakers had hoped. And that matters because we think we could be entering into a world of more frequent adverse supply shocks. If that proves to be the case, then the risk that inflation expectations may dislodge further is a real one. This is a huge change to the way that monetary policy is likely to be conducted in practice. And it's also being compounded by a worrying drop in central bank credibility as inflation continually overshoots their forecasts and rendering their guidance on interest rates quickly out of date. That drop in credibility is in part because central banks were also late to tighten at the start of this cycle based on an overly confident view that expectations would remain low and stable. In the years ahead, it will be monetary policy's role to limit the second round impacts on wage and price setting from supply shocks by managing those expectations. Now, a key question for future rate hiking cycles is whether the post-pandemic lessons have been learned. If policymakers remain vigilant to expectations, then early and aggressive rate hiking cycles will prevail. If they don't, then delayed and ultimately even bigger rate hiking cycles with persistently higher rates will become the norm. We have an open mind about which scenario will prevail. Either way, we think that there'll be a tendency of inflation to surprise to the upside in the medium term in a reverse of the 2010s inflation undershoots. All this implies a more volatile rate cycle going forward and slightly more persistent inflation than we're used to.